Once again, the steps under the acquisition method are as follows. First, identify the acquirer. Second, determine the acquisition date. Third, recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest. And fourth, recognize and measure goodwill or gain on bargain purchase. Step 1 is to identify the acquirer. The acquirer is the entity that obtains control of the acquiree. It is important to be able to identify the acquirer because all of the accounting procedures that we will be learning, from the journal entries and eliminating entries down to the working paper and consolidated financial statements, are done by the acquirer, not the acquiree. Step 2 is to determine the acquisition date. The acquisition date is the date when the acquirer obtained control of the acquiree. This date is significant because whenever we say fair value in business combinations, we often mean to say acquisition date fair value and not the fair value on any other dates. The following items are measured at acquisition date fair values: identifiable assets acquired and liabilities assumed by the acquirer, consideration paid by the acquirer, non-controlling interest, and acquirer's previously held equity in acquiree prior to obtaining control. Step 3 involves the determination of the consideration transferred. Consideration transferred is anything that the acquirer paid or transferred to the owners of the acquiree in exchange for control. The consideration transferred is measured at fair value at acquisition date. It is calculated as the sum of the acquisition date fair values of the assets transferred by the acquirer, the liabilities incurred by the acquirer to former owners of the acquiree, and the equity interest issued by the acquirer. Consideration transferred may include cash or other monetary assets, non-monetary assets, equity instruments, and liabilities, including contingent liabilities. For cash or other monetary assets, if there is deferred payment, or if payment is made more than 1 year from the acquisition date, then there is a need to compute the present value of the future payment using the entity's incremental borrowing rate as the discount rate. Non-monetary assets given up by the acquirer, which may include machinery, equipment, or land. These are measured at acquisition date fair value. Same with equity instruments. The acquirer may issue its own shares or other equity securities to the owners of the acquiree in exchange for control. Again, these equity instruments are measured at acquisition date fair value. Liabilities are also measured at acquisition date fair value. For interest-bearing debt securities, the fair value is oftentimes the face value. On the other hand, for non-interest-bearing debt securities, there is a need to compute for fair value measured by the present values of expected future cash flows. Future losses or other costs expected to be incurred as a result of the combination are not liabilities of the acquirer and are therefore not included in the computation of the fair value of consideration paid. The consideration transferred by the acquirer may also include contingent consideration. Contingent consideration, as the term suggests, the payment of which is contingent upon a future event happening or upon a condition being met. In normal accounting under PAS 37, we only recognize contingent liabilities when they are probable. Probable means more likely than not, or more than 50% likelihood that the liability will become payable. On the other hand, under accounting for business combinations, we can already recognize contingent liabilities even if they are only possible, meaning 50% or less likelihood in becoming payable. With respect to contingent assets, Contingent assets are those assets that are realizable only if a future event occurs or only if a certain condition is met. For contingent assets, under both normal accounting and accounting for business combinations, we do not recognize or disclose unless they become virtually certain. Virtually certain means 90 to 95% chance of becoming realized. Contingent consideration may be payable in cash or in shares or equity securities. If it's payable in cash, then it is recorded as a liability using the account title Estimated Liability for Contingent Consideration. If it's payable in shares or other equity securities, then it is recorded as equity under the account Additional Paid in Capital. The contingent consideration recognized on acquisition date is often based on estimates. If there are any changes to the estimates, then the changes are accounted for either as adjustments to goodwill, or in profit or loss, or not recognized at all. If the amount of contingent consideration changes because of new information about the fair value of the amount of consideration at acquisition date, then retrospective restatement is required. This is when the information already existed on acquisition date, only that the acquirer obtained the information after the acquisition date. If this is the case, then retrospective restatement is required. By retrospective restatement, this means that goodwill will have to be adjusted. On the other hand, if the amount of contingent consideration changes as a result of a post-acquisition event, such as meeting an earnings target, goodwill remains as is, and the change is accounted for as follows. If the contingent consideration is payable in equity, then the original amount recognized is not remeasured. Any difference between the amount paid and the amount recognized is accounted for within equity or APIC. If the contingent consideration is payable in cash or other assets, the changed amount is recognized in profit or loss. For share-based payment awards, the acquirer is obliged to replace the acquiree's awards, and either all or a portion of the market-based measure of the acquirer's replacement awards is included in measuring consideration transferred in the business combination. Acquisition-related costs are excluded from the measurement of the consideration paid, because such costs are not part of the fair value of the acquiree and are not assets. Instead, acquisition costs are accounted for as follows. Direct costs of combination, which include legal fees, finder's fees, and brokerage fees, are expensed outright, unless if the acquirer is an SME. If the acquirer is an SME, then direct costs of combination are included in consideration transferred. Indirect costs of combination, which include costs to maintain an internal acquisition department, general and administrative costs, overhead costs, and other costs which cannot be directly attributable to the particular acquisition, these are expensed outright. Share issuance costs, which include printing of stock certificates, SAC registration fees, and transaction costs such as documentary stamp duties on new shares, these are debited to APIC or share premium from share issuance. If APIC or share premium from share issuance is not enough, then the remainder is charged to retained earnings. Debt issue costs is included as part of the initial carrying amount of the bonds issued. Additional acquisition-related restructuring costs, including shutting down departments, reassigning or eliminating jobs, and changing suppliers or production practices in connecting with business combinations, are expensed as incurred and do not affect acquisition cost. Moreover, listing fees for initial public offering of shares are expensed outright. Let's now take a look at this illustration. You may pause the video to read the illustration thoroughly on your own. The first requirement is to determine the amount of goodwill. First, let's compute for consideration transferred. According to the problem, consideration transferred consists of the following. First, 30,000 unissued shares of its 10 pesos par common stock with a market value of 25 pesos per share. Since consideration transferred is recognized at acquisition date fair value, we'll use the market value of 25 pesos. Hence, that's 30,000 times 25, 750,000. We also have notes payable amounting to 180,000. And lastly, we have contingent consideration of 120,000 payable in cash if the average income during the 2-year period of 20x5, 20x6 exceeds 300,000 per year. Pure estimates that there is a 30% chance or probability that the 120,000 payment will be required. Under normal accounting, we would have not recognized this contingent liability because it is not probable. Recall that probable is more than 50%, but this is just 30%. Hence, we would have not recognized this contingent liability under normal accounting. But under accounting for business combinations, we can already recognize contingent liabilities even if they are just possible and not necessarily probable. Hence, the amount of contingent consideration to be included in consideration transferred is 120,000 times 30%. That's 36,000. All in all, consideration transferred is 966,000. Next, let's compute for fair value net assets of the acquiree. In this problem, the acquiree is Saint. We are given the fair value of Saint's assets and liabilities. Hence, fair value net assets can be computed as total fair value of assets, 1,104,000, minus fair value of accounts payable, 72,000, minus other liabilities, 168,000. Be sure to use fair value instead of book value. Saint's fair value net assets is 864,000. Hence, goodwill is 966,000 minus 864,000, 102,000. The next requirement is to prepare the journal entries in the books of the acquirer, which is pure, in relation to the acquisition of Saint Corporation. This acquisition is an acquisition of net assets. Therefore, we debit all assets acquired, credit all liabilities assumed, credit as well the consideration transferred, and the balancing figure is goodwill. The assets acquired are the following: cash, 24,000, receivables, 48,000, Inventories, 72,000. Land, 240,000. Buildings, net, 360,000. Equipment, net, 300,000. And in-process R&D, 60,000. The liabilities assumed are accounts payable, 72,000, and other liabilities, 168,000. Now to record the consideration transferred. For the common shares, we credit common stock for the par value of the shares. That's 30,000 times 10 pesos, 300,000. We credit APIC or additional paid-in capital for the excess of the market value over the par value. That's 25 pesos minus 10 pesos times 30,000. That's 450,000. We credit notes payable, 180,000. And credit as well estimated liability on contingent consideration, 36,000 or 120,000 times 30%. Since the contingent consideration is payable in cash, we record it as a liability. However, if this had been payable in equity, we would have used APIC instead. Now, the balancing figure of this journal entry is debit goodwill, 102,000. Next, to record the acquisition-related costs. Finder's fees, accounting fees, and legal fees are direct costs. Recall that these are expensed outright. Costs of SEC registration, including accounting and legal fees, and costs of printing and issuing stock certificates, these are share issuance costs, which are debited to APIC or share premium from issuance, but if APIC or share premium is not enough, the remainder is charged to retained earnings. Indirect costs are also expensed outright. To record the direct costs, we debit acquisition-related expenses, and credit cash for 12,000 plus 24,000 plus 42,000. That's a total of 78,000. To record share issuance costs, we debit APIC, credit cash for 18,000 plus 14,400. That's a total of 32,400. Observe that our APIC is enough to absorb the share issuance costs. So far, the APIC of the parent is 240 plus 450. Hence, there is enough APIC to absorb the share issuance costs. If there had been insufficient EPIC, then the remainder of the share issuance costs would have been charged to retained earnings. To record indirect costs, we debit acquisition-related expenses, and credit cash for $27,600. And those are all the entries in the books of the acquirer. For the third requirement, which is to prepare balance sheet immediately after the business combination, we will have this in a subsequent discussion. Let's now take a look at this independent scenario. Assume that on August 31, 20x5, because of improved information about facts and circumstances that existed at the acquisition date, the contingent consideration was revised to an expected value of $60,000. So from the original amount of $36,000, it's now $60,000. That's an increase of $24,000. Now, because the change is due to improved information about facts and circumstances that existed at the acquisition date, the change is adjusted to goodwill. Previously, we have computed goodwill to be $102,000. But with the increase in contingent consideration, our total consideration transferred is now $966,000 plus $24,000, $990,000. Fair value net assets is still $864,000, but goodwill is now $126,000. That's the answer to letter A. Letter B requires us to prepare the journal entry to reflect the adjustment. The journal entry is debit goodwill to increase goodwill and credit estimated liability on contingent consideration to increase the contingent consideration by $24,000. Let's proceed to letter C. On November 1, 20x5, the probability value of the contingent consideration was $78,000. So from $60,000, it's now $78,000. That's an increase of $18,000. However, we will assume that the measurement period has ended on August 1, 20x5, when the acquirer has obtained all the needed information about facts and circumstances that existed at the acquisition date. Hence, the $18,000 is not anymore adjusted to goodwill. So to answer letter I, goodwill stays as is at $126,000. The increase of $18,000 is instead recognized in profit or loss. Profit or loss because the contingent consideration is payable in cash. Had the contingent consideration been payable in equity, we would have not recognized the increase of $18,000 at all. So the journal entry is debit loss on estimated liability on contingent consideration and credit estimated liability on contingent consideration for $18,000. Now on January 1, 20x7, Saint's average income in 20x5 is $324,000 and in 20x6 is $312,000. Both these averages exceed the target of $300,000. Since this is a post-acquisition event, we do not anymore adjust goodwill. Hence, goodwill remains as is at $126,000. Since the target is met, the $120,000 contingent consideration becomes payable. To record the settlement, we debit estimated liability on contingent consideration, $78,000, which is the balance. Credit cash for $120,000. And the balancing figure is loss amounting to $42,000. Had the contingent consideration been payable in equity instead of loss, we debit instead APIC. Let's now take a look at another independent scenario. This time, aside from the contingent consideration payable in cash, we also have contingent consideration payable in 1,200 shares, valued at $18,000. Previously, our total consideration transferred was only $966,000. But with this additional contingent consideration, our total consideration transferred is now $984,000. This brings our goodwill to $120,000. Previously, we have also recorded the following journal entry to record the acquisition. This time, aside from the estimated liability on contingent consideration, we also have to recognize the contingent consideration payable in shares. That's credit APIC for contingent consideration, $18,000. We also debit goodwill for $120,000. Those are requirements A and B respectively. Let's now proceed to requirement C. On January 1, 2007, the target is met or the contingent event happens. This makes the 1,200 shares payable. Hence, the journal entry is debit APIC for CC, $18,000, credit common stock for the par value of the 1,200 shares, that's 1,200 times 10, 12,000, and credit APIC for 6,000. Here is one last independent scenario. In this scenario, we have a contingent consideration payable in 6,000 additional shares. However, we are not given the market value of this contingent consideration on the date of acquisition. Hence, on the date of acquisition, we are unable to record APIC for contingent consideration. So when the 6,000 additional shares become payable, the journal entry is debit additional paid in capital, not additional paid in capital for contingent consideration because we were not able to record APIC for contingent consideration, and credit common stock for the par value of the 6,000 shares. That's 6,000 times 10 pesos. In the next video, we will be computing for consolidated balances on date of acquisition for selected accounts using this memory aid.